uh, as a consumer credit expert, I know that there's a ton of information out there that people get that may not be exactly accurate. So I want to try and dispel some of the myths or some of the misconceptions about credit. Okay. And so what I did is I put together the top 10 do's and don'ts. Okay, the top 10 things, ways that you can help improve your credit score by doing it or not doing it. And so that's what I'm going to share with you tonight. The number 10 thing on my list, and I'm going to share my screen here for a minute, is do not pay for credit. Well, what does that mean? A lot of times you'll see companies out there that'll say, hey, look, you can buy this trade line. It may be Oxbow Publishing, or Ox Publishing, or a jewelry club, or there's even websites where people will add you as an authorized user to their credit card for a fee. And these things could be illegal. At the bare bones minimum, you're taking advantage of people with that are already in financial stress or financial duress, and having them pay for overpriced merchandise or pay an annual fee or a monthly fee for the privilege of having something reported to their credit report. This is the biggest no-no that I can talk about, okay? There are also companies out there. This is actually an actual ad that I pulled off the internet. Start over with a new credit file, $200, and get yourself a CPN number. And this is a huge no-no. I would never, ever, ever want to have a customer get a, do something like that or pay for a credit score by leasing credit or throwing additional money for the privilege of getting a credit score. Does anyone have any questions about this? It seems pretty cut and dry, but I want to make sure that people understand, because for me, this is something I see all the time. And some of you may not be familiar with some of these subsets of the industry that are out there. So I want to make sure your questions are answered. Anyone have any questions about that? Yeah, Sabrina.
So I had asked these questions earlier, so now more in depth of wondering, can you see when someone has like when you're reading credit, can you tell if it has been purchased? Or there's just like, there's no way of knowing, you just know as a customer?
So the customer knows, I know, and most lenders will know because they've seen it enough times, and a lender is likely familiar with companies like Ox or the Jewelry Club or something like that, where so they know that people are doing that. But if you go to a website, like there's a few websites out there where you can, I need to qualify for a home loan. I don't have enough credit, so I'll go on to this website and pay $250, and someone will add me to their Discover card that has 20 years history, a $20,000 credit limit, no late payments, and a low balance. And it only costs me $250 a month, okay? I don't want to do that. I don't want anyone to do that. That industry, to me, is unethical, and it is, in fact, the Federal Trade Commission is taking issue with it, and they're trying to go after some of these companies. That's the reason that the bureaus actually changed the scoring model so that an authorized user account doesn't have as much of an impact on someone's credit score as it used to, okay? They changed the scoring model to make up for that. So no, someone may not be able to tell that you've done some of these things, but I just hate to see these companies taking advantage of people who are already in a desperate situation. Okay, so I would always stay away from these. Any other questions on that? Okay, let's move on to number 9, which is you want to check your credit report regularly. Okay. There's only one website where you can get your annual free credit report, and that's annualcreditreport.com. Actually, right now, because of COVID, it's actually available weekly. It's going to give you the information that is reporting on your credit report, and it'll be 3 separate credit reports, one for each bureau. But there won't be any scores. The only time that you see a credit score is if someone pays for it. Okay, so there will be an option on annualcreditreport.com where you can purchase your credit report. Okay, now in my office, I send people to reportandscores.com to get a tri-merge 3 bureau 3 score credit report, because it has more detailed information. The trade lines are side by side, and you want the most detailed information as possible. You don't need to obsess about your credit report, but I do highly recommend that you look at it once per year so that you can make sure that, is there anything on here that I don't know about? Have there been collection accounts? Have there been inquiries that I didn't, I want to protect myself from identity theft. So I want to make sure that I monitor to see if someone opened up an account in my name. And so that's the reason behind checking your credit report. Even if credit is not important to you, you want to check it just to protect yourself. Okay, you're looking for those errors and omissions. You're looking for, is everything that's on here, is it reporting accurately? Is it reporting completely? Did I open that account? Is there something that showed up? A lot of times maybe a collection item will show up and it's like, I had no idea what this was. What is this, and how do I deal with it? That's where you need to dig into it and see, okay, is this medical debt something that was mine, or should it have been covered by insurance and it just slipped through the crack? And a lot of times, looking at the credit report, this is the first time that someone actually sees that this is here. Okay, so that's why we want to take a look at it at least once a year. Any questions on the credit report? Yes, ma'am. Leslie.
If you've frozen your credit, you can't check it, correct?
So yeah, that's correct. Because you've placed a freeze on it, you need to undo the freeze if you're going to check your credit report. Presumably, if you've got all 3 bureaus frozen, they shouldn't be able to issue credit to anyone. But that doesn't mean that a collection item won't show up. Okay, because if something's gone to collections and it's like, well, I don't have any credit cards, I don't have any loans, why would something go to collections? Well, medical debt. Okay, and this is something, because this is what I do for a living. I actually watched testimony before the Senate Finance Committee one time. This was, I don't know, 5-6 years ago. And the CEOs from all 3 bureaus were testifying before Congress. And one of the senators asked, does medical debt impact your credit score? And the CEO for one of the big 3 credit reporting agencies said no. Okay. Did he lie? Did he not lie? Well, the problem is that the senator didn't know the next question to ask, which was, if medical debt is turned over to a collection agency, does it impact your credit score? Okay. Because technically, medical debt does not impact your credit score. But once it's been sold to a third-party debt collector, they can now report it, and that will definitely impact your credit score. Okay? So even if you don't have any, or your client doesn't have any other credit, you still want to check once a year just to see, did something go to collections? Is someone trying to make inquiries under my name? And that just protects yourself. Okay, so that's why I recommend at least once a year, check your credit, just to see what's going on. Does that answer your question, Leslie?
Yes, thank you.
Okay. Any other questions? Outstanding. All right, let's move on here real quick, and we're going to go, let's see. Okay. A lot of people put a lot of stress about inquiries when they're looking at your credit. And so there's a difference between soft and hard inquiries. And so we're going to talk about that a little bit. If you are applying for a credit card, a mortgage, even getting a cell phone contract, or asking your credit card company to increase your balance, or earlier this year, SBA was doing business loans and they pulled people's credit. All of those are going to be hard inquiries. Okay. A soft inquiry is going to be when a company does they ask the bureaus to give them a list of people in a certain area that meet certain criteria. That's a marketing inquiry. That's a soft pull. That doesn't impact your credit score. If you as the consumer check your own credit score, that doesn't impact it. Getting life insurance or car insurance, any type of insurance policy. If an employer runs your credit score, none of that is going to impact your credit score. If you are opening up a checking account, that could be either one. It depends on the bank. A lot of banks, and Wells Fargo actually got in trouble for this for a few years ago, because every person that opened up a bank account, they tried to pre-qualify them for a credit card. Okay, and I don't know if you all remember that, but that's what they were doing, and they got into trouble for that. So that was a hard inquiry. So they're applying for a rental application, getting a utility, that's going to be a hard inquiry. Okay. Now, the deal with the inquiries, if it's a hard inquiry, it's going to impact your credit score. If it's a soft inquiry, that does not impact your credit score. Now, the impact to your credit score is relatively small in comparison to other things on your credit report. And we'll get into this a little bit later when we talk about the credit mix and the things that make up the credit report. But the inquiry has very little impact on the score. Okay. A lot of people, and I know that we've had this discussion in the last couple of days, Sabrina, in the auto business. A lot of people say, yeah, I went to this dealership and they ran my credit like 50 times, and that's what's bringing my scores down. And the reality of it is that it's not the 50 inquiries, it's the one new loan that's bringing the scores down. Because we as consumers were protected, and if we do our shopping for an auto within 14 days, we can have our credit pulled 100 times and it only counts as a single inquiry. Okay. The same thing with a mortgage. As long as if we go shopping a mortgage and we have 10 different mortgage officers pull our credit report, if we do it in a 45-day period, it only counts as a single inquiry. Okay. So the different inquiries don't have a huge impact on your score, with the caveat of unless you go out today and you apply for a couple of credit cards, a car loan, a mortgage, all in the same period, because then what it does is it flags the bureaus to say, ooh, this person's going out and trying to get as much credit as they possibly can. They just became a high risk for filing bankruptcy. Okay, now why would the bureaus think that? Well, because historically people have done that. Okay, a lot of people have done that, where right before the darkest hours financially, and they already know that they're probably going to file bankruptcy, they go out and get as much credit as they can and then file bankruptcy against it. Okay, so typically for the average consumer, those inquiries don't have much of an impact. Any questions on that? Yes, ma'am.
The only question that I have is a hard inquiry lasts on your credit for 7 years as well. It takes, how long is the time frame that it does sit on your credit?
Yeah, so most of your inquiries are going to come off your credit in 2 years. Okay, that's the impact that they're going to have. Now, you may, if you pull a consumer poll, you'll be able to see inquiries that are older, but after 2 years, they quit having an impact on your score. Any other questions? All right, let's keep moving on. Okay, new accounts. This makes up 10% of your credit score. Okay, and so when we're talking about how do I want to impact my credit score? Well, I want to limit the number of new accounts that I open. Now, as a financial coach, I always want to teach my clients that good credit does not have to equal debt. Okay, so if I want great credit, then yeah, I got to have some accounts that are open, and I have to, there's a certain way to manage them, and we'll talk about that in a few minutes. But I have to understand that if I open up a new installment loan, it's going to bring my credit score down for 1 year. So when we were talking about those inquiries just a few minutes ago, again, that auto loan, all of those inquiries that the dealership put you through, that's not what brought your score down. It's that new auto loan, that new installment loan, which is a set amount for a set period of time. Okay, that new account is what brought my scores down. And it takes about a year to recover from that. But after about 5 or 6 months, your scores will start to go back up because it's become what we call seasoned. Okay, you're paying it on time and you're doing what you're supposed to, so it'll start to recover, but you don't really recover until the end of a year. Okay, if you start getting, if you have 2 or 3 new accounts in the last 12 to 18 months, that's going to hurt your credit score a little bit. Okay, it makes up about 10% of your credit score. So it's not a huge impact, but it is an impact to your credit score. So you want to limit how many new accounts that you open. And of course, as a financial coach, my advice is, look, we got to come up with a new plan. We got to be more intentional with our money. We got to, refocus on what's important and gain control of our finances so that we're not relying on new lines of credit. Now, I have business clients who, in order to grow, they have to have the ability to take out loans that they're going to be a personal guarantor on. Great. Let's be strategic about how we do that so that it fits in with your plan, and that's an appreciating asset that can help you make money instead of a depreciating asset that's going to lose money. Okay. Bottom line is, new accounts make up about 10% of your credit, so we need to be careful on how and how often we're opening up those new accounts. Any questions on that piece?
How often should you be opening new accounts?
Depends on what your goal is. If your goal is to eliminate debt and create wealth, never. Okay, you need roughly, at least 2, no more than 3 revolving credit cards, and that's it. Okay, and we're going to talk about how to manage those credit cards in a few minutes so that, again, you don't have debt. Okay, and I know I've said this 1,000 times, and I'll say it 1,000 more. A car loan is the single biggest detractor to wealth that there is. Okay, that's my opinion. In my humble opinion, IMHO. I believe that a car note, because people get so caught up with having that car note, having a new car, all they pay on for the first 2-3 years is interest, and then they figure they have to have a new car, and so they roll over negative equity. They're always upside down. They can never get out from underneath it, and so they're always, the average car note is about $550 for a 7-year period, 6 to 7 year period. And I can think of so many other things that you could be doing with that money to help you create wealth instead of maintain a lifestyle. Okay. So how many accounts should you have open? Again, that goes back to, do you want good credit or great credit? Okay. If you want great credit, all of the FICO, which is the Fair Isaac Corporation, the people who make the scoring model, they will all tell you that you have to have 3 credit cards, 1 car loan, and a mortgage in order to have great credit. I don't care about great credit, because with good credit, I'm still going to get, if I'm going to buy a home, I'm still going to get an excellent rate and term with good credit without incurring more debt than I'm comfortable with. Okay. I'm comfortable if I have a mortgage for a few years. Okay. I'm not comfortable if I have car payments and a personal loan and a furniture store loan and a credit card at Victoria's Secret and Best Buy. And, now because I've got all these different loans and my hours got cut, now I've got to go to the payday loan place just to make it to my next paycheck, and it becomes this cycle that gets increasingly difficult to get out from underneath. So my answer, Sabrina, is how many new accounts do you need? None. Okay. How many are you going to have? It depends on where you're trying to be and what, again, I've got business clients who may not have any personal debt, but they do have debt on their credit report because, it's difficult to buy a $450,000 excavator and pay cash for that. And if they don't have that excavator, they're going to lose out on, $2.3 million worth of revenue this year. Okay. Is there a trade-off? Yeah. But you got to be strategic. And so that's what we talk about. Does that help? Okay. Any other questions on this piece? Yes, sir. Joe.
Yes. Does it make a difference if you have more than 3 on your credit bureau, whether it's open or closed, or whether you're using it or not?
Credit cards?
Yeah.
Okay. So if you, and we're going to talk about credit cards here in a few minutes. But when I talk about having good credit, you want to have at least 2, no more than 3 open revolving credit cards. And we'll talk in a minute on how to manage those, because that's the important part, is to remember that good credit does not have to equal debt. So we want to make sure that we're not incurring debt as we go through this process. Does that make sense? Okay. And I'll get into details about that here in just a few minutes.
All right. Sounds good. Thanks.
Any other questions on the new accounts or installment loans? Awesome. Let me take us to the next screen. Okay, and here we're going to talk about credit mix, and we touched on this briefly. This makes up about 10% of your credit score, and because it only makes up 10% of your credit score, that's why I'm not too concerned about it. Okay, the perfect credit mix to get you into the 800 club, where your score is an 800 to an 850, that's where you have to have a mortgage loan, a car loan, and 3 credit cards. Okay. It only makes up 10% of your credit score. I'm not concerned about this. And when people focus so much on, I got to be in the 800 club, I have, the difference in rates and term for someone with a 680 or 700 credit score and an 800 credit score is really pretty nominal. Okay. And personally, I don't want myself or my clients to take on that debt load in order to get a better credit score. Does that make sense? Okay. So as long as I have 2 to 3 open active accounts, even if they're all 3 revolving credit cards, I'm okay with that. I'm going to have a good credit score. I'm going to be able to qualify for the things that I need. Now, if I had student loans, if I had a mortgage, if I had a car payment and I paid all that stuff off, all of that stuff, once you pay it off, it will continue to stay on your credit report for 10 years and have a positive impact on your score for 10 years from the day it's closed. Okay. So, keep that in mind, that history of having had a mortgage or having had a car payment will stay on there. Again, I don't ever want to have a car payment. I don't want my kids to have a car payment. I don't want my customers to have a car payment. A mortgage, that's a different story. Okay. Any questions on the out? Yes, Karen.
Yes, in a situation, let's just say, one I'm familiar with, after a divorce is a situation where, let's say the wife or husband, whoever, has the ability to, buy a house in cash versus get a mortgage loan. In your opinion, which is the better route to go? Is it, it's kind of a catch-22 where you want to be able to, it's better than having credit card debt, but isn't it better to have a mortgage than what I've kind of have learned and not,
Right.
maybe have invested that money better and still had a mortgage loan where it would have showed, where I was making payments on my own for 10 years as a single mom, single.
I hear you, and I understand where you're coming from, but I would disagree with the premise. And there is no substitute for the peace of mind that living debt-free can bring you. Okay. Now, I hate to do what I refer to as drive-by coaching, which is we don't have all the information and you're asking me what the right answer is. And I'm giving you a off-the-cuff answer based on limited information. But typically, overall, again, I want my clients to have the freedom to live debt-free. Okay. There's so much more that you can do with life, with, just an abundance of life when you're debt-free. Okay. So, the argument can always be made that, well, I can get a mortgage for for 2.25% or 2.5% now, and I can invest this money in the market and get 12%. That argument can always be made, but now my house is at risk. And I've seen in my lifetime the market tank multiple times. Okay. And so why would I want where I live to be at risk? The argument can be made that you can do that, but I just don't believe it. Okay. And there are other ways to establish credit as a newly divorced or single mom that will not put you and your family at risk. Is that fair?
It is, yes. I wish I had played all those options back at, years ago when that was the situation. I guess in the long, not knowing what the picture is, but I guess having a mortgage debt is better than having a bunch of credit card debt. But then again,
okay. So yeah, if we want to get into what debt is better, yeah, absolutely. An appreciating debt is your home or something that will help you create revenue. Okay. Everything else is pretty much a depreciating debt. Your car note, that when you drive that car off the lot, it's going to depreciate by what, 20-30%. Okay, before more before the time you get to sell it. Credit cards. How sick to your stomach would it be if you're carrying credit card debt and you think of the fact that you just paid interest of how much amount on a Subway sandwich that you ate 9 months ago? Okay, you're still paying interest on that sub sandwich. Okay. Not that I'm not dogging Subway, just if anyone's, okay. I'm just saying that there is no sandwich. I'm a big fan of In-N-Out Burger, but I don't want to pay interest on In-N-Out Burger.
Right.
Okay. So yes, there are levels of good and bad debt, I suppose. Okay. And
The
actually, I guess I
situation.
would say that debt is not animate, so it can't be good or bad. It just debt is, and I don't want to live in debt. So my recommendation,
Yeah.
90% of the time, is going to be pay off the house, live debt free. If you were going to have a finance that house and have a $1,500 or $2,000 a month payment, dump that money into the market every month because you're debt free and you can still do that. And now you're participating in what's referred to as dollar cost averaging, and you'll be you'll get back to where you would have been. Okay.
Okay.
All right.
Yes, but when somebody, as far as, wish I could quit saying, I used to not say that. Now it's like, I don't need any credit score. I can pay cash. What about that type of person that?
Yeah, absolutely. People can pay cash. The only issue that I have with that, because I've been doing this a long time, most people can't afford to pay cash for their house. So at some point in their life, they do need credit for something. Okay, be it to pay cash for a house or whatever. And yes, there are companies out there who can do what's referred to as manual underwriting and help you get that mortgage without a credit score. That's fine, unless, unbeknownst to you, a collection item for medical debt, for an old utility bill, for an old whatever apartment complex that you lived in, any of that collection item shows up on your account and you have no credit history. Okay, because if you have a 0 credit score, nothing's on there, you're good to go. If you have a 450 credit score because you have no good credit and you now have these collection items on there, you're not going to get approved for anyone, no matter how much, how long you've been at your job, how much money you have in the bank, what your job pays you, you're not going to. So I do not, if people want to live completely debt-free with no credit, more power to you. Just understand that if you need that credit, if you need to purchase a home and at that point they determine that there's a collection item there, now you have no positive credit history to offset this collection item. Does that make sense?
Absolutely.
Okay. Anyone have any questions? All right, let's move on to the next piece. And that is collection accounts. Okay, this is where I've seen a lot of mortgage professionals, lending professionals erroneously give not the best advice to their customers. Okay. And I know that there are no mortgage officers out there who intentionally want to do harm to their clients, but some of this comes down to just a lack of knowledge. Okay. As a financial coach, when I have someone come to me in crisis who is dealing with collection accounts, the first thing that I want to do is say, okay, look, we need to refocus on what's important and gain control of your situation and make sure that we're keeping a roof over your head, food on the table, utilities on, the car on the road so that you can get to and from work and earn a living. Those have to be our priorities. Okay. And so I'll draw an arbitrary line in the sand of what gets paid, and the things that have to get paid are above the line, and collection items are going to be below that line. Okay. And there are a few things that I want to do. And so we do this by taking a look at the credit report and saying, okay, how old is this debt? And we want to know that because there's two different things that we look at. One of them is statute of limitations. The other is obsolescence period. So how old is that debt? And that the statute of limitations and the obsolescence period are both determined by what's referred to as the date of first delinquency with the original creditor. Okay, so if you go back to, I had a Capital One account, and this was, in 2015, July of 2015, I made my last payment on it. So if my last payment was July of 2015, the date of first delinquency would be August of 2015. Okay, and that's the date that starts the clock for both the statute of limitations and the obsolescence period. What's the difference between those two things? Statute of limitations means, how long can I be sued for this? Okay, and that's going to be different by state. In the state of Texas, that statute of limitations is going to be 4 years. Okay, so if I made my last payment July of 2015, the date of first delinquency clock started on August of 2015. That means after, and I don't make another payment after August of 2019, I can no longer be sued for that debt. It can still report to my credit report, but I can't be sued for it. Okay, that no longer becomes a priority for my clients in crisis. Okay, because paying it off can actually do more harm than good. Now, the other piece to that is the obsolescence period. Most debt can stay on your credit report for 7 years. It starts with the same date. So if August of 2015 was the start date, that means August of 2022, it has to come off my credit report. Okay, that's going to be most late payments, charge-offs, collections, a Chapter 13 bankruptcy. A Chapter 7 bankruptcy can stay on for up to 10 years. Okay, in order for that information to stay on your credit report, it has to be 100% complete, accurate, timely, and verifiable. That's what federal law requires. That's what they allow for. And you have the federal right to ask for validation, verification of what's being reported. Okay, that's a different topic for a different night, but what it is very, very important that you look at the statute of limitations and you look at whether or not this is something that you need to be concerned with. If it is within the statute of limitations, so I made my last payment in April of this year. Is it a liability? Well, it's still, for me, it's below the line. So until I get control of my spending plan, until I get control of paying the rent or the mortgage, keeping food on the table, paying utilities, all that kind of stuff, that collection item still stays below the line. But I need to be aware of it more because it could become a liability where I could get sued. Okay. Once I have my spending plan in order and I come up with, I put aside enough money, maybe I go to them and I offer a settlement. Okay. Because I'm, my job is to be worried about credit. I'm going to encourage my clients to request that in addition to the settlement, that they take, if it's $1,000 debt, hey, look, times are tight. I can give you $250, but I need you to remove it from my credit report. And you get that agreement in writing. They may come back and say, yeah, we can't do 25%, but we'll settle for 50%. Okay. I just saved $500 and it's coming off my credit report. That's how we deal with collection accounts. The impact on credit score that collection items have. Remember when I talked about the late payments, the more recent that late payment is, or the more recent that collection item is, the more of a negative impact it has on your credit score. Okay. Thanks for coming out, Lisa. So the more recent it is, the more of a negative the more of a negative impact it has on the credit score. Okay. The older it gets, the less of an impact it has on your score. Does that make sense? Okay. Any questions on collection accounts? Yes, Sabrina.
So you're saying that because I heard you say that sometimes paying it off can hurt you. Are you saying like the older accounts paying that off will hurt you more than the ones that you should be paying off, I guess, in time order, something that's closer to you versus further away in time order?
Yeah, so there is a little bit of strategy to it, and it depends on what you're trying to do. Obviously, if it's an open active account, you want to put that into your debt snowball and try to eliminate that debt as fast as you possibly can. Once it has gone to collections, I'm not going to worry about it until I have to, because I've got these other priorities, these other things that are more important to me. If it's outside the statute of limitations, there are some collection agencies out there who will do what is called re-aging, which means that they will make it look more recent than it actually is, and that will hurt your credit score. And so you want to be cognizant of that. You want to be aware of that. Yes, ma'am.
Okay. So I understand the aging process. Then I have one more question for you.
Mhm.
I've heard that some collection agencies, if they can't collect on your debt, they'll then sell you to another collection agency, and so on and so forth, until either somebody gets it or, let's say, the 7 years comes. Is it true that when they resell your information, they don't necessarily always give them everything intact, which is how it ties into making sure that everything is accurate?
Yes, absolutely. The collection account, the life cycle of a debt, when you stop paying a credit card company, they'll usually hold on to it for about 6 months, and then they'll charge it off. They may continue to try to collect it internally for a little bit longer before they either assign it to a debt collector or sell it to a debt buyer. Okay. At that point, those people will try to collect on it. When it comes to reporting, that credit card company can no longer report a balance. Only one person can report a balance at a time. So that collection agency, if they're reporting, they can report a balance. If they're unable to collect, they can sell it to someone else who can sell it to someone else. They can continue trying to collect on it for as long as they want. They just can't report it past 7 years. I was talking to a client earlier today who had a collection letter that they got from a company on a debt that was from a prior marriage, and he's been married now to his current wife for 20 years. Okay. And they sent him a letter saying, hey, you want to pay this now? They can do that. They can't take him to court. They can't sue him. They can't garnish his wages. They have no legal recourse, but they can ask him, hey, you want to pay it now? How about now? You want to pay it now? And that's okay. They just can't, they have no recourse. They can't report it or anything like that.
Do you ever find that people do re-report the same debt? So as it's been, let's say, passed along to the fifth collector, have you ever seen that sometimes, I know you're saying re-aging is an issue, but is re-reporting the same debt an issue as well?
Yeah, only one agency can report the debt at a time. Occasionally you'll see that, but that's an easy fix. What I would be more concerned about is companies who are collecting on zombie debt, which is debt that's really old, or even debt that's already been paid off, that they go and they especially target senior citizens and the immigrant community, to try and talk them into paying something that they don't even have to pay. And that's with debt collectors, that's more my concern than the misreporting, because we can take care of the misreporting. Okay.
Hey, Dave,
Really,
I have a question.
question, buddy.
Yep. So with the reagent, what it sounds like to me is a collection, I'm trying to get a proper understanding, but a collection company would report to your credit bureau, say a debt from that originally got sold to them in like 2016, 2017. They reported on your account as opened April 2020. Is that what reaging is, or is that just
Correct.
in?
Correct. Instead of, remember, I said that the statute of limitations and obsolescence period was based on the date of first delinquency, which
Right.
is, in the case of most debt, the month after you made the last payment to the original creditor. With medical debt, it's considered the date of service. So whenever you had that medical service. And so if that was, in our hypothetical scenario, it was August of 2015, and this collection agency buys it, and they say that it's brand new debt from, August of 2020. That's re-aging, and that's actually illegal. But there's a lot of collection companies that will do that because there's an immediate drop in your credit score, and so there's an immediate desire to get that fixed, and so a lot of people will be compelled to pay that, even though they may not be required to legally or lawfully.
Yeah, it's a good tactic. I remember you covered that. Thank you for refreshing. But I didn't ask you right. I'm trying to make sure I get the verbiage right. So I see an account that says open, that's not the same as them just reporting current. If it was just being reported current, they wouldn't even. It wouldn't be posted like that into the credit report. Is that correct?
I think I understand what you're saying, which is as a collection agency, they can report that they just purchased it and the date they purchased it, as long as they are still reporting the date of first delinquency with the original creditor.
Also reporting. Okay, so that's how you know that. Okay.
Right.
If they're not reporting that, then it's definitely being re-aged. It has to be congruent across both ends. Okay.
Correct.
All right. Thanks.
Okay. Any other questions on that?
So I just want to make sure I understand, like in a situation, I think that he was talking about. So, I mean, is it something to where they can sell that within like, less than 7 years, let's say, right? So then it, again, it wouldn't re-age unless there was current lateness or current late payment.
Yeah,
right?
so a collection item can never re-age, okay, legally. They will re-age it. What starts the clock, again, is that date of first delinquency.
Okay.
So talking to, and people will think, well, if I talk to them, they'll change the activity date. Talking to them does not change the activity date. It's okay to talk to them. It's okay to communicate, make sure they have all your information, that they have a good address for you. You always make sure they have a good address for you. That doesn't change the date or the date.
And is that something, we all do with, someone with Omega, is to go back and let's just say, a certain amount of debt was re-aged, or I would say not re-aged, it was actually sold to somebody else and they're stating that it's a new date?
So part of what we do when we're helping the clients with their credit issues is we're looking at the statute of limitations, we're looking at the obsolescence period, we're looking at the accuracy and completeness of what's being reported, and we're trying to protect the consumer and their federally granted rights by holding these companies accountable for what they're reporting and how they're reporting, okay, to make sure that it's 100% complete, accurate, timely, and verifiable. Okay. All right. So let's keep on trucking here. And now we're going to get to some of the big ones. Paying on time. This actually makes up 35% of your credit score. Okay. Are you paying your bills? Are you paying them on time? This is incredibly important to know, because you want to make sure that, I remember earlier I said the more recent that late payment, the more of a negative impact it has on your credit score. And I can't tell you how many times I have the conversation with people, well, I had this on auto draft out of my account, so it's not my fault. Yes, it is. But I had it on auto draft and the bank screwed it up. Still your fault. Okay. It is. And that's why when I'm working with my clients, I want to, my coaching clients specifically, I want to stress the importance of a good spending plan. Okay. Because if you don't have that spending plan, then you don't know, you're not being intentional with your finances. And I want you to be intentional with your finances so that this kind of thing doesn't happen to you. We're trying to eliminate debt, but in the meantime, you still have minimum payments that are due. Okay. And even if you have it set on an auto draft, you want to be able to look at your spending plan and check it off. Okay, that came out of the account, that came out of the account, that came out. Oh, this one didn't come out of the account. I wonder what happened there. And it's your responsibility as the consumer to make sure that got paid. It's not the bank's responsibility. It's not the creditor's responsibility. It's your responsibility as the consumer to make sure that that debt gets paid. This makes up 35% of your credit score. So this is a huge impact. Okay, is whether or not you're paying stuff on time. So I cannot stress enough the need for a good spending plan so that you can keep track of all of your debt and all of your payments that are due, and make sure that you're paying things on time. Okay. Any question? Yeah, Joe, you got a question?
Yeah. When you say paying on time, let's say you miss your payment, but it won't show up in your credit report unless you pay it within those 30 days, correct?
Correct. Okay.
Okay.
So if your payment was due on the 22nd, okay, and you forgot to pay it today, and you pay it tomorrow, or you pay it on the 1st when you get paid next, you may get hit with a late fee, but it's not going to impact your credit until you get to the 22nd of January. Okay, that first 30-day window.
Okay, because most like a car payment, they give you the next 10 days to pay it off before you get a late fee. Okay, all right.
Yeah.
Can I ask a question right there? Maybe I missed
Absolutely.
something.
What you got, Lewis?
Now on a car payment, sometimes I see people, they pay interest only like for 1 month, and they add another payment at the end of it. Does that affect your credit?
Okay, so it doesn't impact your credit unless it can impact you if it's a lease, not a purchase, because they're
Okay.
tacking that payment on to the end, but you don't have the right to keep that car past the end of the payment or the end of the period. So in other words, if they tack that on to the end, you have to turn the car in a month before you have your last payment.
Okay.
Okay. So,
Okay.
And again, we're hoping that we're not making interest only payments. We really want to attack the principal and eliminate this debt as quickly as we possibly can.
And the only reason I'm asking is because I had COVID in July and I was in the hospital, right, for a month, right? So obviously with the payments and everything, so we just called the car company, said we could just pay the interest on it and make, just to pay the interest that month, put the in at the note. But they were good enough for us to we didn't have to make a payment that month because I was in the hospital with COVID, and they were real good with me. Capital One. So
yeah, no, that's not going to impact your credit score.
Okay.
And David, correct me if I'm wrong, but like in his situation, if he had been current prior to when he got COVID, actually right now with the CARES Act, it wouldn't even be reported that he would be delinquent had it been over the 30 days, right?
No, it can still report as being delinquent. They just can't really do anything about it. Even with the CARES Act, if you're delinquent, they can still report that it's delinquent. Okay, unless you communicate with them prior to being delinquent. Okay, and that's the mistake that people make, is there are rights out there to protect you, but you still have to communicate people, and you have to tell your creditor what's going on in your life. Okay, the number of times that I've seen women who were in abusive relationships and moved out of an apartment complex and just bailed, and now they're upset because they have a collection item on their account for this apartment, and they had to get out of that bad situation. I get it, and I applaud you for having the courage to get up and leave. Had you gone to the apartment complex manager and said, I'm out of here, or even if you just went to them after the fact with a police report, they cannot collect on that in the state of Texas. They can't, if you're in an abusive relationship, you're protected, and you can leave without that coming back to hurt you. Same thing with these late payments on the CARES Act. You still have to communicate. You can't just stop paying your landlord. You can't just stop paying your car payment or your credit card. Most of these companies have programs in place, but you have to communicate with them. Okay. All right. I want to move along here pretty quick. I do want to be respectful of everyone's time. And we got a couple more slides to go through. Length of history. This makes up about 15% of your credit score. So it's important to not close accounts. You can quit using them, okay, but you don't want to necessarily close them. To get the greatest or to establish yourself in the credit bureaus, you need to be with the bureaus, have an open account for about 7 years. Okay. Once that account is closed, if it's a positive account, it will continue to have an impact on your score for 10 years from the day it's closed. Okay. So that's why, great, pay it off, but don't necessarily close it. Okay. The other part that impacts is what's called credit utilization ratio. Because let's say I have a credit card. Let's say I've got 2 credit cards. Okay. Both of them have a $10,000 credit limit. One of them I pay off and it's at a 0 balance. The other one I do not pay off and it has a $5,000 balance. Okay. When I had both of those open, I had $20,000 of available credit limit and I had a $5,000 balance. So my credit utilization ratio was 25%. Okay. When I closed that first credit card, I lose the $10,000 credit limit, and now I have a $10,000 credit limit and a $5,000 balance. So I jump from a 25% credit utilization ratio to a 50% credit utilization ratio. Okay. So, and we're going to talk, the last thing we're going to talk about tonight is credit utilization ratio. Okay. Because credit utilization ratio makes up a third of your credit score. Okay. This is the single piece that you can impact. Okay. And it can have the greatest impact, the fastest on your credit score. Okay. I don't want to ask, I don't want people to say, but most people carry at least one credit card, or they have one credit card. Okay. Most people do not know what day of the month that credit card reports to the bureaus, because your credit card balance only matters one day out of the month. And that's the day that it reports to the bureau. The rest of the month, it can be a 0 balance. Okay. So what you need to do is you need to call the credit card company, find out what day of the month they report to the bureaus, and then 4 or 5 days prior to that report date, charge $10 or $15 on that card. Do that by paying a bill you would pay anyways. Put your Netflix bill on it, your Spotify bill, something small that's 10, 15 bucks that you're going to pay for anyways. Let it report to the bureaus, and then the day after the report date, pay it off. Okay. By doing that, you are controlling what's being reported to the bureaus. You are having a direct impact on your credit score, and you're not incurring debt that is unmanageable. Okay. You don't need to run up the balance on the credit card and pay it down in order to have a good credit score. You don't need to charge on it every week and then pay it off every 10 days to get a good score. You don't need to do any of those. You don't need to jump through any of those hoops. If you know the day that it reports to the bureaus and it reports a $15 balance, that's going to have a huge impact on your scores. The reason for that is because credit utilization ratio, like I said, it makes up a third of your credit score, 30%. Okay. And the way that works is, what are the balances in relationship to the credit limit? If anyone remembers when they were a kid playing on the playground, playing on a seesaw. Okay. Anyone remember that? Okay, don't be shy. I did. That's how your credit works. It's an inverse relationship. Okay, so if your balance is way down here, that's the lowest possible balance. That's between $1 and 10% of the credit limit. The other side of the seesaw is way up in the air. That's the greatest possible impact to your credit score. If your balance goes up to 11 to 20%, the other side of the seesaw, that positive impact has to come down a little bit, okay? If that balance goes up a little bit more, 21 to 30%, that positive impact comes down a little bit more. 31 to 40%, 41 to 50%, and then a zero balance, okay? Effectively, having a zero balance on your credit card is the same as having a 50% balance on your credit card. Once it goes over that, 51 to 60, 61 to 70, 71 to 80, you can see the positive impact of your score is getting lower and lower and lower. So in order to get the positive impact back, you pay it down, leave a $10, $15 balance on it, you'll have the greatest possible positive impact. And because we want to be debt-free, the day after the report date, we're gonna pay that off. We're not carrying a balance, we're not paying interest, so it doesn't matter what the interest rate is, because we're just managing it to participate in the game that has been set up for us, and no one wants us to know the rules. That's how you play the game. Okay, any questions on that?
Have those numbers changed over the past years? If that's kind of the way it's been for a while, or?
That's the way it's been for a while. A lot of people will say you need to be under 50%. You need to be under 30%. 30% is a popular number. And the reality is it's weird. So the lower the better, but above zero. And the reason why a lot of people will go with higher numbers is because it's hard to tell someone, no, you need to pay it off and you need to have a balance under 10%, because that's saying that you can be under 30% or under 50% is non-confrontational. Okay, people don't want to have the discussion that debt is bad, and debt is bad, and I'm in the industry. Okay, I don't want you to be in debt. I want you to be free. I want you to have that freedom. And so just because it's easier to say, oh no, just pay it down as much as you can, as if you're under 30%, you're in great shape. Yeah, you're in better shape than if you were at 70%. Okay, but you're not in the best place credit score wise or financially. That makes sense?
It does. I'm just, I'm trying to think, is there something, and I may be, so let's say that they can't pay it off. Is there something about like pay the balance off by 30, 35%, or, and then go back and then charge it again, or,
So look, again, your balance only matters on that one day of the month that it reports, okay? So on that day, you pay it down as much as you possibly can. If you have to charge something on it again, you need a better spending plan, okay? You need to work with a financial coach to get your spending plan in order so that you're not incurring new debt when you can't afford the debt you already have. That's just my opinion. I could be wrong. I doubt it, but I could be. Okay. Any other questions?
thank you.
All right. I want to thank you all for joining me tonight. I hope that I was able to provide some value, some information that maybe you didn't have before. If you have any additional questions, please feel free to reach out to me. Obviously, this is something that I'm passionate about. I can talk about credit all day, every day. And so I'd be more than happy to entertain those conversations. I'm going to go ahead and stop the recording.